Today is Monday, September 13th, and this is the ADM Investor Services weekly market kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services, Archer Financial Services, or ADM. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, Alan Bush, ADM Investor Services Senior Financial Economist, and special guest Mark Soderberg, Archer Financial Services Senior Ag Risk Specialist. Mark, let's start this morning with this question. On Friday, the USDA released their September production and supply demand reports. What was your take from the USDA numbers?
Well, good morning, Kurt. There were really no major shocks from the USDA on Friday. Leading up to Friday's reports, the market was braced for higher production figures in both corn and soybeans, and that's exactly what we got. In corn, production was raised nearly 250 million bushels to just under 15 billion. Well, this was in line with expectations, and if realized, it would be the second largest crop ever. This was a result of both acres going up and the expected yield from the USDA. That stands at 176.3, just shy of the record yield of 176.6 a few years ago. In soybeans, production was raised 35 million bushels to 4.374 billion. Also, in line with expectations, third highest crop ever. Acres there were actually cut a little bit, but that was offset from a higher yield, now placed at 50.6 by the USDA. That would be the second highest yielding crop ever, or matching the second highest yielding crop. Both corn and soybeans on the demand side of the equation, old crop demand was cut a little bit as some of the demand figures started to tail off towards the last couple of months of the old crop marketing year. And part of the higher production and carry-in estimates on new crop were offset with higher demand on new crop. In the end, ending stocks, 1.4 billion, just over that in corn, in line with what the market thought, and in soybeans there too, much in line with what we pre-report expectations were. I think the biggest thing I got of Friday's numbers were on the global balance sheet. The USDA did not lower the Chinese import forecast for both corn and soybeans. They were kept the same. And in fact, on soybeans, they've raised their old crop import forecast a little bit. I think there was some skepticism in the marketplace that these numbers were vulnerable to reductions. They did raise the Chinese production numbers, but they kept that import forecast the same. So for now, at least from the USDA perspective, they're expecting a strong source of demand from China, and with the U.S. Likely being a leading supplier.
Thank you, Mark. Steve, do you have any takeaways from Friday's report? And especially, could you comment on the expected yields? Do you believe we'll see those record yields?
I think that, first of all, the headline was that the carryouts here in the U.S. for corn and beans went up. That's negative. And I think as far as the demand numbers are concerned, the corn export number could be bigger, which could bring the carryout down. I think most private analysts have carryouts in corn for 21-22 lower than the USDA. But we kind of need a spark, actual numbers, China buying corn, other origins buying corn, to kind of turn the market around. And then as far as yields are concerned, the crop ratings right now are below where they were last year and August 1st. And so the yields are actually up. So I think at the end of the day, it's going to be interesting to hear yield data from the farmers and see if the corn yield actually goes down a little bit on the October report. But beans, I got a shot of rain late in the season, and that yield could actually get a little bit bigger.
Mark, over the next 3-4 weeks, or until we have another significant USDA report, what will have the biggest impact on prices?
Alluding to what Steve had mentioned, I agree. The actual yield data from the U.S. farmer is going to be of utmost importance. Weather here in the U.S. is becoming less and less significant and starting to change to weather in South America becoming more significant. So number one is the actual yield reports from the farmers, and two, the demand. We got big demand numbers out there by the USDA. China has bought some U.S. beans here as of late. So we've picked up the pace there. On corn, we're sitting at record export numbers on the books on new crop right now, but that's all corn that China had booked this past spring in early summer months. So, there too, I think we just really need a spark of additional demand or confirmation, perhaps that the crop conditions are a better reflection of yield and that they're going to tend lower here as we get deeper and deeper into harvest. So, those are the things that we're looking for, as we move through the month of September and towards the next USDA reports.
Steve, what should traders be looking at right now?
Well, I think first of all, Hurricane Ida just disrupted the Gulf export capacity, and we've got to get those elevators back up and running because the funds will not buy the market as long as they're not loading out. I think secondly, when you look at USDA's 22 numbers, all the crops are bigger, and so rebound in Russian wheat, rebound in Canada wheat, rebound in South American corn and soybeans. So we have kind of a narrow window here in which prices could rally after harvest, unless La Nina comes in and lowers production in South America and here in the United States in 2022.
Steve, perhaps you can comment on the net funds position in the grains and also if we're near any significant technical areas that traders should be watching.
Well, the funds have liquidated out of most of their big positions. They're still long a little bit of corn, beans, and oil, but they're short meal and wheat right now. And they've been selling ever since that bullish August report. And I think it had initially concern about the demand side of things, but then the hurricane really knocked the markets below some key support. There's very, very strong resistance at 13.25 in November beans and 5.25 to 5.40 in December corn, $7 Chicago and Kansas City wheat. I see no reason for us to trade over that level. There are some people that think that we are going to trade back below the $12 beans and $5 corn level through harvest and unless the demand picks up and if there's no weather problems in South America.
Mark, one more question for you. Stretching things out a bit, what kind of price action do you think we can see moving into the fourth quarter of 2021 and let's say over the next 3 to 4 months?
Well, I think that production will be the key over the next 3 to 4 months. We're in a kind of a unique situation where the USDA lowered production for both corn and soybeans in the month of August and then turn around and raise them again in the month of September. Historically, this doesn't happen a great deal of time over the years. However, when it does, there's a very high likelihood of further production increases into the final numbers in January. So I think the market is leaning toward bigger production numbers from the USDA. So to me, at the moment, the easier argument to make is to continue to kind of grind sideways to lower until either one of two things happen. Either that production starts to trend lower from actual yield reports or USDA numbers, or we start to see a big influx of buying here from China. Until those things happen, I think the funds will continue to shed a little bit more length in the marketplace. I think we do have risk back under that $5 level again, and D's corn that we briefly penetrated on Friday. 480 is kind of a number I've been looking at from a longer term perspective. We have a chart, a gap in the charts there from last March. So I think that's our downside risk. Upside potential if we do start tending lower end of production and or Chinese starts to make some big purchases. I think the 550, 560 areas could come back into play. There are some big moving average numbers up there. On soybeans, I think we're closer to arguing that we could have seen the low there than we do in corn. We have seen exports pick up in recent weeks to China, and I think that's only going to continue to become a bigger talking point as South American supplies dwindle and the U.S. will once again dominate the global trade. So while I think we have risk down to $12, I don't think we'll penetrate it. And if the exports really get up and going again, I would not be surprised to see us back up into that 1380, maybe even 1420 level on the high side.
Guys, let's just spend a few minutes on the financials. Alan, September is typically a weak month for stock index futures. Do you expect this year to follow suit?
So yes, there is a seasonal that shows a little bit of weakness in September, and in fact, we are down today, or I should say early this month, but higher today. Also, we have a downtrend line that is coming in, but no, I do not think the seasonal will work this year. I think that the fundamentals remain on balance bullish, and that we will see higher prices. In fact, I would not be surprised to see this downtrend line taken out on the upside. So despite the seasonal, I would look for near-term strength in stock index futures.
Alan, what can you share with the viewers regarding your outlook for inflation currently in the U.S.?
Well, of course, inflation has been a big problem. We all know that, but I do believe that we have seen peak inflation. From here, though, inflation numbers still likely to be elevated, but not at the extremes that we have seen in recent months. Of course, we do have the consumer price index for August due tomorrow morning, and the estimate on that is up 0.4%. So going forward, I still see plenty of inflation, but not the extreme numbers that we have seen as of late.
Finally, Alan, one more question. Looking at the 30-year T-bond market, the interest rates, how would you trade it right now?
I would be trading the bonds from the long side. Now, the bonds have been in a 2-month symmetrical congestion pattern, and the rule of thumb is that futures usually break out of a pattern of this nature in the same direction that they came into the pattern, which would be to the upside, and that takes place approximately 65% of the time when we do see patterns of this nature. Plus, the fundamentals, I believe, still are bullish on balance, as there is continuing economic numbers suggesting that the global economic recovery may be slowing. So I'm looking for a breakout to the upside in the 30-year Treasury bond futures. And I think this is a trend that will probably continue, I would think, for several months at least.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services, Archer Financial Services, or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.